Before we start here, just make sure everybody's got a workbook, and you have my business card there. My name is Tim Dern. I'm going to be your presenter tonight. Sometimes people come in here, they may have a question while they're here, and then they get home and they say, oh man, I have this question. I forgot to ask the guy there. So if you get home and you want to call me or email me or something on a question, feel free to do that. I'll explain that. Our presentation today is going to be about 90 minutes. It's an hour and a half. This is a power-packed information class. You will not be bored. I move very quick. I would encourage you to take notes because there's a lot of information about Social Security, and there's a lot of rule changes. One of the things that we find out with people when they're talking and looking online or talking to the Social Security Administration office, sometimes the information is confusing, and sometimes you're reading something on the internet that you can no longer do on Social Security. So today you're going to get a lot of updated information. You'll make sure you have the right things that we have there. I would ask you, just because I'm doing a recording here tonight, I don't really want to stop and answer any questions because we're putting this on tape for training purposes. But I will say this, at the end of this meeting, if I did not answer a question that you have, by all means, I want you to come on up and ask me your question before you leave. I find it very difficult to get information about Social Security, and you're going to have opportunity today to get a lot of the correct information, so before you leave, I want to make sure we answer your questions. We're going to be talking about Social Security and all the benefits and how that works, and we're going to be talking about how that works when you're doing retirement income. The connection I want you to think about: when you're collecting a Social Security benefit in retirement, you're going to be taxed on that money a lot different than you're going to get if you're pulling money from a 401k or a joint account or so on and so forth. So sometimes people are a little confused on how does all the taxes work when I'm putting my retirement income plan together. We're going to cover all that. I do want you to know that I am a financial advisor. You're going to hear my 5-minute commercial here in just a second on who I am and what I do. But I want you to know tonight, we're not buying you dinner and we're not trying to sell you anything. So you just kind of rest assured this is all about education. Don't get me wrong, I do get clients out of here, but nobody's soliciting anybody tonight. So you can kind of keep rest assured about that. The reason I'm here is it's on behalf of this nonprofit organization. You probably had gotten a mailer in the mail, or maybe you saw this on a Facebook. The advertisement is coming from the Association of Financial Consultants. This is kind of our give back to the local community. We do seminars, free education seminars, all around the communities here. I'm in Schaumburg, I'm in Bartlett, I'm in Aurora. We go all the way from Naperville to Mount Prospect. We talk about Social Security, we talk about Medicare, we talk about taxes in retirement, all different kinds of free education that nobody's trying to sell anything. We're just trying to educate people in the community. The key I would tell you, if you look at the top there and it says AFC, that logo, if you see advertisements out there, and if you ever go to my website, you have my business card, go to my website, you'll see a lot of the free events that we do. You see that AFC logo, you know that it's free. Nobody's going to try to sell you anything. It's just our part of free education, okay? We're going to do this in 3 sections. We're going to talk about Social Security today, of course, and all the rules and the updates. You'll hear that. We will be talking about Medicare Part B. Medicare Part B is tied into your Social Security benefit, and we're going to explain how that works. And in that last section, when we start talking about when you start turning on Social Security and you're drawing from other accounts, how does the taxes and how does your retirement income look? And I'm going to tell you that section is very confusing. Now, you may have an advisor that you're working with that can help you. Maybe you're trying to do this on your own. I just want you to know I'm going to share some strategies that I do with my own clients. So you're going to kind of get a preview of what I do. You want to take these strategies to your own advisor, go ahead. If you want to try to do them on your own, fine. If you want to make an appointment and come and talk with me more specific, I would welcome that too. The one disclaimer that I want to tell you, though, is when we give you these topics, I do want you to know that this is just for educational purposes. Don't leave here thinking this is a specific thing for you. So we'll talk about that. But when we talk about Social Security in that section, we're going to say, how much will you get? When do you claim? How is Social Security taxed? Other Social Security benefits, ex-spouse, spousal benefits, deceased spouse, even disability. We're going to cover all of these things. And we're going to show you some new rules. I've got to tell you that these new rules that have been gone for a couple of years, I'm going to tell you some examples of clients that I had just this week that are still thinking they can do some of this stuff that you can't do for the last 2 years. They're confused, they don't know, so we're going to try and educate you on that. When we talk about Medicare Part B, we're going to talk about the monthly cost for Medicare Part B. We're also going to be talking about extra costs called IRMA. These are IRMA taxes that is income-related extra tax on your Medicare Part B. And this, again, is very confusing in how that works. And what are all these penalties associated with that? So we'll cover that. Make sure you avoid the penalties. And then when should I enroll in Medicare and when should I not enroll in Medicare? A lot of confusion on that part. If you're working and you're covered at work, do I need to enroll? We're going to cover all that. Make sure we cover that. And then, again, we'll talk about these penalties and make sure you avoid the penalties there. The last section, when we're doing this retirement income, we're going to be talking about strategies that help you plan for 25 years in retirement. And we're going to show you how your money can last through that. And there's these things called RMDs, required minimum distributions. They come out of your qualified accounts. You have to pull money out and you have to pay tax. So we're going to be talking about your qualified money and how does that affect Social Security tax and how does that affect all your other taxes. You're going to be glad you came. I do a lot of these classes on different topics. This is the favorite one. People will say this is the class they want to go to, so you're in the right class for this one. The end of this, we're going to be talking about how do you diversify your investments to make it 25 years in the market. We're going to have good times and bad times in the market. How do you survive all that? I'll show you what we do. And then we're going to talk to you about these different money buckets that we set up. And this is the strategies that we use to help people survive in retirement. We'll show you how all that works. Now, of course, this is my disclaimer. People will say to me right up front, do you work for the IRS? I do not. I'm not associated with the Social Security Administration. I don't work for the IRS. I'm an independent financial advisor. I'll give you my credentials in a second and a little bit about that. But again, I'm going to show you these strategies, and you're going to get it. But please don't leave here saying, hey, the guy said I should do it this way because of that tax thing or whatever. I want everybody to understand, if you came in and met with me and we had specific conversations about your needs and your goals, we would make a custom strategy for you. We just don't throw the one out there for everybody, but I want you to see why you may want to do something so you understand, you'll get it. But please understand, if you want specifics, we have to chat about that. A little bit about me and my credentials. So first of all, I am a fiduciary. I'm an investment advisor. I am what's called an RICP, Retirement Income Certified Professional. So in our business, I have securities license, I have insurance license, certifications for all kinds of Medicare stuff, a lot of certifications you hear about for Social Security. We do this, but my focus is an additional training on retirement income planning. We are working a little bit different than maybe if you have an investment advisor at Fidelity or Merrill Lynch or Edward Jones. Nothing wrong with any of these firms. If you have your money there and you're invested in some kind of a portfolio, that's okay. But sometimes if you ask that advisor, what about a question about Social Security, question about Medicare, or even an income plan, they might not know. We specialize in retirement income planning. Most of the clients I have are within 4 or 5 years from retiring. Many of my clients have already retired. I'm very familiar with the rules and regulations in this space. We do this every day. I'm also going to tell you that I'm 67 years old, been married for 43 years. I have 3 grown kids. I got 8 grandkids. This is where I am in my own life. I have not turned on a Social Security benefit yet. And as we start to tell you, I'm going to explain why. One thing I would tell you about this fiduciary, it's very important. If you're talking to advisors today, you're going to hear this term fiduciary. Fiduciary rule simply means this. In our business, if we're managing your money in a brokerage account or doing some investments with you, there's fees associated with that. That's how we earn money. Wherever your money is right now, you're paying fees. You should understand what you're paying and how the advisor is paid. As a fiduciary, we have to disclose all of this. If you want to do an insurance product, life insurance, Medicare, annuity, something like that, that is a commission to an advisor. As a fiduciary, we have to disclose how we're getting paid, and we always have to make our recommendation based on your best interests. It's always the client first, not how much money we make. Not all advisors out there are fiduciaries. So if you're getting a recommendation sometime from an advisor, how do you know where that's coming from? If you work with fiduciaries, you're going to understand a lot more. Hey, this is what I get, this is what you get, and everybody really understands how everything works. We're independent. You know, we've all kind of worked for other firms, so we're an independent firm. These are just two partners on my team, Sean Hughes and Ethan. I've got about 5 or 6 guys that are in our office, and I got a private wealth firm with about 45 people running that firm. So and you'll hear a little bit more about what we do, but we got a lot of people. Our company is called Manna Financial Group. Manna, you know, from heaven. This is kind of where we are. We want to serve the community with honor and integrity. That's what we're trying to do. Now, what's crazy about this, these young guys have me on the internet doing presentations like this all over the country now, and now I'm licensed in 35 different states. This morning, I had a client on a Zoom call from Dallas. How would you ever get a client from Dallas? Because he saw some of my information on the internet and he called me. He said, "You're the guy I want to talk to. Nobody can help me with this." Well, here we go. Now, technology, here's how it goes. If you did decide to do business with us, our money is at Schwab. So, you know, you're either at Schwab or Fidelity or Vanguard or whatever, but Schwab is where we work with. But it is not Schwab managing the money. We have our own private wealth team that does that. So just so to clarify that. Now, besides all these licenses and things we have, I have also taken a course that I had to pass in a series of classes and an exam on the rules of Social Security. And there are a lot of rules about Social Security. I completed that course. I have a very strong knowledge of how Social Security works. I'm actually listed on the website as a National Social Security Advisor. I've got a lot of expertise in this area. Now, I'm up here bragging, and I'm going to tell you, you may come up to me at the end of this meeting and say, "Hey, I got a question about Social Security," and I might not know the answer. And if I don't know, I'm going to tell you I don't know, but I will tell you this, I could probably find out the answer to your question by me going to my team of people here than you going on the internet or making a few phone calls. So even if you have a question and it come up and ask me and I can't answer, I'm going to tell you I'm going to help you find out that answer for you. Now, these are just different publications that I've been publishing articles in. A lot of this has to do with mistakes that people are making when they're claiming a Social Security benefit, or some strategies that can actually maximize a higher benefit. Those are all coming out in some of these publications. Been on a lot of the local news here. This is WGN, different news segments. On with Sylvia Perez and Mark. These are just different things we have in the Chicago area. My partner Sean's been on a lot of these different things. They always take the younger guys on the more powerful TV at times. But we do get some exposure out there. We also have cable shows running in the area, so you might see something about us on that. Just one last thing. My office is in Schaumburg, right across the street from Woodfield Mall. So if you did say, "Hey, listen, I'd like to come and have a talk with you," you'd come to Schaumburg and meet us there. I also have an office in Naperville. We work both sides there. So again, if you're interested and you want to talk to us, you can come to one of the offices. So thank you very much for hearing my commercial. The last thing I want to say before we get into the Social Security matter, I want to identify a couple of risks as an advisor. This is the advisor talking, and I've been doing this for many years now, and I want you to know I see things and common mistakes that people have, but I want to point out a couple of things to get you thinking about your Social Security benefit and your retirement. These are some risks that could disrupt your retirement. You've been saving your whole life, and then you get to the end and you go, "Okay, this money's now got to last me." Well, what happens? Well, first of all, stock market crash could be a lot more serious when you're not working and you're not contributing to these accounts. You're not getting a paycheck anymore and you're living on these investments and the market drops 40 or 50%. You're going to feel that a whole lot different than before. So we have to protect a little bit more in retirement against that. We talk about income risk. Am I going to have enough money to last me the rest of my life? That is a very major concern for most people in retirement. What about health risk? Hey, Tim, I got plenty of money. We are set to go. And then all of a sudden, here's a stroke, here's a heart attack, here's a death. Does that change people's retirement? Yes, it does. How do you prepare for some of that stuff? We're going to mention a few things. What about tax risk? We were all told when we were contributing to these 401ks and 403bs, hey, you put the money in there, you're going to defer the tax later because when you retire, you're going to be in a lower tax bracket, and then you're going to use that money. Sounds great, but I'm here to tell you that's not always true. Sometimes I find people that have a lot of money are in a very high tax bracket all the way into retirement. And that could be one of the highest expenses you might have in retirement is taxes. We're going to show you a few things to kind of how to mitigate that today as well. The last thing I want to tell you is this is something called legislative risk. This is Washington changing the rules that could affect your retirement. Like what about Social Security running out of money? There's a very big concern about that. We're going to show you how this legislative risk, they've already changed the rules on yours and mine 401k, any qualified money, they've already changed the rules, and a lot of people don't even understand what's happening. We are a country that's $34 trillion in debt, yes? All these baby boomers retiring have trillions of dollars in these retirement accounts. Do you think the government is watching? Yes, they are. And are they want their taxes on that money? Yes, they do. Are they starting to do some legislative things? Yes, they are. And I'm going to make sure you're aware of some of this because it's happening right now and most people don't even see it. That's that legislative risk, and we're in election year. And if we have a Democratic Party wins the election or a Republican Party wins the election, we'll see what happens with these different legislative things about taxes and different things that are going to happen, because this is what we're all waiting to see is who wins this and what's going to happen to yours and my money based on the decisions going on in Washington. Let's start this part about Social Security, and if you got a pad, we want to start taking some notes. I do want to start out, when I was doing the education for this and we started talking about President Roosevelt signed this into law in 1935. A couple of interesting things I found that was, to me interesting. He said this would start when people turned 65 and you would get paid until you die. And I thought this is great. What was the life expectancy of a male in 1935? 66, and a female was 68. How long did they think they were going to be paying people on? And of course, not long. Now, let me hear the funny part about this. For many, many, many years, people now are living longer into their 80s, 90s. They haven't changed these rules. This is blowing up Social Security. They didn't change a lot of rules for Medicare. Is Medicare being overloaded? The answer is yes. But it's a little shocking and surprising to me that they weren't making changes to this sooner. This is kind of recent changes to try to shore this up. But anyway, it was started out to be, well, we're just going to pay people for a few years, and that's not what's happening. People are living a lot longer. One last thing about this, and I thought this was interesting, it was the law. If you claimed a Social Security benefit, you would never pay any income tax on that benefit. How many know that's changed? Legislative risk. Could they change it again? Yes, they could. Social Security, today, 186 million workers covered, 67 million people are collecting. This is $1 trillion a year. It's a big deal now. $1 trillion going into people on Social Security. Now, of 67 million people collecting, look at this. The average benefit's $1,700 a month. This is a little bit of a wake-up call. If you're somebody who's been making $100,000 a year and you say, okay, I'm ready to retire, I deal with this every day, and they say, how much is my Social Security benefit? And people go, what? What? Social Security is not designed to get you rich. Now, some of you are going to make more than this. Some of you might even make less than this. We're going to show you how they calculate your benefit. But it's interesting, nobody's getting rich on Social Security. And that's really, as an advisor, when I start talking to people, and of course people are getting ready to retire, and we start looking at their Social Security benefit before we look at anything else, and they find out, wow, I make $135,000 a year, and I'm going to go to $2,000 a month or $3,000, whatever it is. Sometimes it's a little bit shocking. So you'll have to decide on your own. These are the updates for 2024 on Social Security. So keep this in mind. First of all, they had a cost of living adjustment this year of 3.2%. If you were collecting a Social Security benefit, you're going to notice that you got an increase because of cost of living. Now, last year, that cost of living adjustment was 8.7. And then people were like, hey, this is fantastic. I'm getting an upgrade on my Social Security. I'm getting a raise. Here's my thing as an advisor. Anytime you see a cost of living adjustment that's above 1 or 2%, this is not a good sign for our economy. This is saying inflation, and I'm just telling you, when you start thinking about how much everything costs today and what's happening, that 3.2% is not even keeping up with what's happening in inflation. But even though we're getting some increases, that's not a good sign. That's actually an indicator that we look at to see what's happening in the economy. But it is down a little bit from last year, but we're still not where we need to be on this. You're going to notice that you've been contributing out of your paycheck, or however you're paying into FICA wages. You used to pay up to $160,000 a year. So for example, if I made $200,000 this year, I was only contributing to Social Security up to $160,000, and after that I was not. Well, now they've changed it to $168,000. So again, I'm making $200,000. I'm contributing more of my money towards Social Security. Keep an eye on this. This is going to keep going up. Why? Because Social Security needs money. We'll see where these changes go in the future. The last thing down there is another change, Medicare Part B, which used to be $164 a month last year. They raised it this year to $174, and we already know that's going to $185 starting in January. Again, keep an eye on this. Anytime we have inflation and these things going on, this is going to affect you and I because we're the ones that have to pay all of this, but this is how it goes. People will ask me, well, how do I contribute to Social Security? Well, you contribute to Social Security through FICA. Now, if you're working for some employer, well, then you're paying some of this out of your paycheck, and the employer is paying some of this for the paycheck. But if you're self-employed, you're going to pay both of these costs. But notice, and maybe you're not aware, but 15.3 again is up from last year. You don't even know this, but you're paying more money out of your paycheck into Social Security right now. Is that going to go up next year? Well, it's just more money that's coming out of your check going into Social Security. And if you have to have an additional tax for Medicare. So besides the FICA wages that going into Social Security, you're paying an extra tax for Medicare. And if you're a high earner, you're going to pay an extra tax for Medicare. What? Does it ever stop? No, it doesn't stop. This is our system that we're on. I'm going to explain how this is going to affect you in retirement, and I'm going to say this to you now before we get to the section. This is more complicated than most people think. When I meet people, they come in and they kind of have this idea, oh, I'm just going to claim my Social Security benefit, and then I'm going to do this and I'm going to do that. When they start getting into all the mechanics I'm about to share you, they go, wow, there is way more to think about than this. And I kind of got to say it to you this way. Do not let any relative, any friend tell you when is the best time for you to claim your benefit. Just this morning in my office, I had a lady come in. Nice lady, she has good money. She's retired at 62 and a half, going to be 63. And she has her Social Security benefit turned on. So she turned it on early. She doesn't need the money, but she turned it on. I'm just curious. I'm not judging. I'm not trying to do anything. I just kind of commented to her. I said, can I just ask you, curious, why did you turn your Social Security on early? You don't need the money. And she does this thing where she points her finger at me like this. She says, my sister said, get in there and get your money. That system's going broke. You get in there and get money before it runs out of money. Can anybody relate to this? Exactly. Now, here's how I play this. I go, oh, your sister works for Social Security? Oh, no, no, Tim, she works for Macy's. But she went on the internet and she read and she saw. Now, after a little bit of conversation, I showed her how that's going to cost her a lot of money in retirement. That was not the correct move for her. But I'm sure her sister, all good intention, was trying to give her some information. You will have people telling you how to collect a Social Security benefit, and even an advisor, even me, if you come to me, I'm going to tell you your options, but I'm not going to tell you when is the best time for you. You need to see everything yourself, make sure you understand, and then we make the decision. I can help you make the decision, but it's your decision individually. We're going to be talking about 2 trust funds. One is old age and survivor insurance. That's a Social Security benefit. Don't you just love that? Old age and survivor. You're just going to survive. We hope you make it. Hey, can they come up? And then you're going to see disability insurance in a different trust fund. As I talk about how Social Security works, we're going to cover both of those. Now, make a note of this. Most people don't realize this. How is Social Security funded? Is this part of the government's national debt? No. So how do they fund Social Security? Look at this. Current workers, people that are working today and paying into Social Security, me, you if you're still working, we are the ones paying for the people's Social Security benefits that are already out there. This Social Security system we have is completely dependent on the workforce. And it's a little scary when you start thinking about what could happen to this country. There used to be 9 workers for every 1 Social Security collector. We're down to 2.5 workers for every. You see what's happening? This is a Ponzi scheme. If it was anybody but the government, they would be in jail. Some people think, oh, the government's funding this. They are not. We all are dependent on the workforce. When you leave work, you hope the force behind you is still working, because that's how Social Security works. And that's what's a little alarming right now, because we're seeing Social Security starting to run out of money, the workforce shrinking, and it's putting people into a little bit of an uneasy feeling about their retirement. I'm going to show you how you can maybe protect yourself on some of this when we get to the other section. Now, you've been contributing to Social Security your whole life, and this is really funny. I do have people like this. They'll tell me, they come in, they go, you know, Tim, I've been paying into this Social Security, every day for when I turn mine on, I want every single dollar that I can get, and they try to time when is the best time. You're going to see you're going to have different ages where you could claim. And they're always saying, I want every dollar. And they say, can you help me get a maximum payment? I said, yes. Tell me when you're going to die, and we're going to nail this. Because it's based on your life expectancy. Nobody knows. You're never going to nail it. You're going to make the decision the best you can for you, but do you think you're going to get every dollar you're supposed to get? That might not happen, and you're okay with that. We just want to make sure you can maximize the benefit at your age when you're ready to do this. We'll talk to you about that. That whole idea about Social Security being broke is a very common thing. So I asked the question, is Social Security broke? How many say yes? How many say no? How many don't know? So let's talk about this. Social Security right now is not broke. The reason I point this out, if you're somebody that's close to claiming a Social Security benefit right now, don't make the number one reason you want to collect because the Social Security system's going broke, because it's not broke now. And that should not be your main reason to go in there and get that. I'm going to show you some other things to think about. But there is a lot of talk about Social Security is going to have a 1/3 shortfall in 2034. And they've known about this for many years. They already see this train coming. This is the reason that you're seeing a lot of Social Security changes and different things, because they're trying to keep this shored up. So when clients come in and they're very concerned about this, we might take some of your other retirement money and put it in something to make sure if Social Security does drop a little bit, do you have some guaranteed income that might offset that? That's some of the things that we're doing. I don't know where this is going to be in 2034. I kind of been under the belief that we're probably going to be fine. This will be a political football, though. This election, you're going to hear this batted and talk. I think our age group is going to be fine. I worry about my children, my kids, probably going to be a completely different system. But we're going to see, but right now there's a lot of things that say we're going to run short. Now there are changes that they're making that's helping this. And that's why I want to make sure you're aware of the changes, because that's what's happening. You have to be eligible for Social Security. Social Security is not welfare. You have to pay in and you have to qualify for a benefit to get money out. So how do you qualify? Well, first of all, you have to be a worker who's paid into FICA for at least 10 years. They do not have to be 10 years consecutive. You might have been somebody that went to work, worked for 3 years and took a break. Maybe you were raising children. Maybe you didn't work for 20 years. You went back to work. But as long as you have a work record that equals at least 10 years, you're going to have a Social Security benefit. I do find clients that come in and we look at their Social Security report and they do not have a benefit. And we find out you only have 9.6 years of work. You got to go get a job for 6 more months and then you'll something like that, but you have to at least put in 10 years. And then the only other way that you get this is you have to age in. You reach a certain age, and that's how you qualify for Social Security. Now, this spouse or ex-spouse benefit is a little bit of a different twist. You could actually be somebody who's never contributed to Social Security. Maybe you're not even born in this country, but if you marry somebody who's getting a Social Security benefit, could you get a Social Security benefit off of their benefit? Yes. What about a divorce or an ex-spouse? Can I get a Social Security benefit off my ex? Yes. We're going to explain how all this works. What about a deceased spouse? He never got to use his money or her money. Can I? Yes, you can. You can. I'm going to show you this. You can even have, you'll see on there if you have dependent children, you have dependent parents. I think about this guy that came in and he was 68, I think 69 years old, and he had an 11-year-old child at home. He's collecting Social Security, but he collected his Social Security and then he got an extra benefit for his 11-year-old child. And there's some rules on how this works, but somebody said to me one time, how can a 68-year-old have an 11-year-old child? I see first marriages, second marriages, third marriages. This is what's happening in our world today. But if you are somebody that has a young child collecting or you have a dependent child, can you get extra benefits? You can. We're going to explain some of this. The last thing I want to mention, though, is I get a lot of questions, too, on disability. If you're somebody who's collecting a disability check and you're on what's called long-term disability, so maybe you're collecting this and you're not going to be able to go back to work and maybe you're already qualified for Medicare, the concern is people will come to me and say, Tim, I've been on disability for a while. Now I'm coming into my full retirement age. What's going to happen to my disability check? Am I going to lose it? And I say, here's what's going to happen to you. Your money is going to it's going to be the same money. You don't have to file. You don't have to do anything. But you are going to notice when your birthday comes at full retirement age, they are now going to call you Social Security. You were disability before that, but then you're going to be Social Security. They were paying you out of the one bucket all this time, and now they're switching over and paying you onto that bucket. But you don't do anything. You don't have. This is an automatic thing that actually happens. So if you're on disability, know somebody on disability, they don't have to worry. This just kind of works that way. Social Security, new rules. I want to point this one out, and this is something that I'm telling you, you can't do this anymore. But I have clients that, well, I'll tell you, came in, husband and wife came in, and one of the first things they said to me, which was kind of funny, we start talking about, okay, retirement, what's it going to look like? We start talking about Social Security benefit, different retirement accounts. We start talking about when we were going to claim the Social Security strategy, and he looks at me and he goes, I want to do the thing my brother did. I go, what'd your brother do? And he explains to me, and I go, wait a minute, how old's your brother? Which was older, and I had to tell him, look, your brother could do that, you can't do that. That's gone. I can't do this anymore. Let me explain what this worked and how it did. So this was called file and suspend. So I have a Social Security benefit, and my wife has her own Social Security benefit. When we reached the minimum age, I could actually file for Social Security, but suspend claiming the money. So I just filed and suspended. My wife would file and suspend. This allowed us back then for me to go in and take half of my wife's money. She took half of my money, and then we lived on that money until our Social Security benefits got higher, and then we switched back. And everybody was doing this. And I had all this special software, and when you came in as a couple, we would run, okay, who does this? We were doing strategies on Social Security like no tomorrow. This is gone. And this has been gone for several years, because Social Security is running out of money and people are double dipping on that. So what I want you to know right now, and make sure this is something you make a note of, if you claim a benefit, your own, or you claim a spouse. That is it for the rest of your life. There is no longer a switch benefit. And I've had clients that came in that told me the last advisor told me to go take half of the benefit. Now you just forfeited your full benefit because you cannot switch back now. Now, I'm going to tell you, not all advisors understand these rules. So if you're getting closer to retirement, you're going to want to make sure you're talking to somebody who really understands that, because that's a really major problem right there, that somebody gave the wrong advice on that. So I'm telling you, you can't switch your benefit once you claim. That's gone. I see it on the internet. I still think things about that, and people say, hey, I still want it. You can't do it. Can't do it. Be very careful on that. Now, what we're going to talk about is, when are you eligible to claim a benefit? You're going to notice when you reach the age 62, you're going to be eligible for your Social Security benefit. And they're going to look at an 8-year window, so 62, 63, 64, all these ages, and you're going to decide it stops at 70. So it starts at a little smaller amount, and it grows a little bit each year, and then it maxes at 70. So all of us have to decide which one of those years is the best time for me to claim my benefit. So everybody in the room, you've been on the internet, you've been looking at this, somebody in here has done the math. When's the best time? Who knows? 70? Who else? When's the best time to claim a benefit?
It depends on your situation.
Why?
It depends on your own particular situation and how old you are.
You think so? Is that what you found on the internet? I'm playing with you. Let's take a look. What I tell people is exactly what you're saying. This is an individual choice. It's a personal choice. Everything you said, it depends. What does it depend on? When I'm coaching my clients, I say the first thing I want to consider is, when do you need the money? Meaning, sometimes people turn 62, they don't have any other money. They're going to need to go claim their Social Security benefit. I get that. I'm somebody who's past my full retirement age. I'm going to be 68. I don't need my Social Security benefit. I'm still working. I'm going to delay. So obviously, we're talking about, are you still working, and everything's individual. Life expectancy. This is a good one I get. I have friends of mine that I play golf with, and they're always doing this. Hey, Tim, I'm turning on my Social Security at 62. I start laughing. I go, why? You don't need the money. I'm going to die early. Everybody in my family dies, and it would bug me if I died and I didn't get any of my Social Security benefit. And I'm laughing. I get what, right? We hear this? But I'll say something like this. Well, what if you're one that lives to 85? You know how much money you're going to live on the table? Of course, we don't know when we're going to die, but does life expectancy matter? It does. So you got to kind of think this through a little bit. And again, we have to make our own decision. Employment status, do you have other things? These are all the things. But again, what we said, it's an individual choice. And we're going to show you how we teach people when's the best time for you. Just a second. We do have people, and this is the decision we're all going to make. We're working, but when do we retire? And if you just have Social Security and that's the only money you have, you may think, I can't retire. And I'm going to tell you, this is the times we're in right now. Money is tight. Things are costing more. I see people every day that had planned on retiring, and they're going, I can't do it. I got to work a couple more years. We won't make it if I retire. This is a very real thing that's going on. All of us have to make this decision. But that now, if you're somebody who's worked, got Social Security, you got plenty of retirement accounts, savings, maybe you've inherited money, it's a little different for you. But again, we got to work through these decisions and say, do you have enough money to retire and feel safe in retirement? That's what we all have to do. Let's start talking about your Social Security benefit. First of all, when you turn your benefit on, you're going to get that payment on a monthly basis until you die. It's every month until you die. Now, if you die, Social Security does give you or your spouse, if you're married, a one-time death benefit. Does anybody know how much that is? Anybody? $250? How do you know that? It used to be $250, but they raised it. It's $255 now. Tell me where they get this number. I can't even imagine, but that is the one-time death benefit. You've put in money in this $255. It's crazy. One thing I'll tell you about claiming that's just kind of a fun fact, I'm thinking about a couple, they're both born in April, and when they went in to claim their benefits, they noticed that the one spouse was getting a check on this, I mean, it's not a check, but getting paid electronically on the second week of the month, and the other spouse was getting it the fourth week of the month. Can anybody think about maybe why? Day of the month of the birthday. If you're born on the 10th and I'm born on the 22nd, you will see payments come at different times. So that's just something when you go in, they're going to ask you the day of the month, when your birthday is. But once you get your payment, it's pretty consistent. It'll be there until you die. It's guaranteed till you die. Now, you can get cost of living adjustments. We've already talked about that. Now, here I'm putting this in red. And I'm telling you, make a note of this. Your Social Security benefit is a tax-preferred asset. And I'm going to say this to you a couple of times. How you are taxed on Social Security is different than money coming out of an IRA or a 401k or any of that kind of stuff. And if you have an advisor that understands this, I'm going to show you how you can mitigate some taxes in retirement. I'm going to come to that, but a lot of people are not aware that your Social Security is the tax-preferred investment, not your other investments. I'll show you how this works. Now, Social Security, and we're going to talk about your own benefit, so let's make sure you're taking notes here. This is where you need to take notes. These are two terms and two things that you need to know about Social Security, and this is the jargon, this is the language, this is how Social Security talks. If you're talking to somebody at the Social Security office and they're talking about FRA and PIA and all this stuff, you're going to be very confused. So you need to know full FRA, which is your full retirement age, PIA, primary insurance amount. Now let me explain how these two work. First of all, full retirement age is really just based on the year you were born. This chart, you can Google it, it's everywhere on the internet, but you can see the chart over there. If you were born between 43 and 54, your full retirement age is 66. I've highlighted me, 1956 is my year. You see that says 66 and 4 months. You'll see 66, 8 months, 10 months, and then of course anybody after 1960 is 67. I have had people come into me as a client telling me my last advisor said that 4 months, 6 months doesn't matter. And I say, who told you that? Because if you get this wrong, there are penalties against your Social Security benefit. And I'm telling you, know your full retirement age. So I'm going to tell you, mine is 66 and 4 months. I'm going to keep an eye on that. Now, the second part of this is called primary insurance amount. This is the dollar amount based on your earning record on what you would get at your full retirement age. So think about if you got a statement in the mail from Social Security, or you went online and you saw up in the top right-hand corner $2,200 a month. That is your PIA. That's how much you would get at 67, for instance. You don't get $2,200 or $2,100 if you claim at 62. You're going to get less. So people are always doing this thing, well, my Social Security is $2,200. They go, which number? Is that your PIA? Social Security is going to go off PIA, and then you're either going to go early or you're going to go late, and that's how they do it. How do they figure out your PIA? It's based on your own personal earning record. They're going to take 10 years, of course, to qualify, but they're going to take an average of the highest 35 years of your career. And I'm going to tell you, me and many people I see, we all started out, we had these jobs, McDonald's, I was a waiter. They're part of my earning record, but I wasn't making a lot of money there. You might have some people that say, Tim, I didn't work for 10 years. I was raising children. Well, you got 10 years of zero in there. So when they take the money that you did make and then they factor in those 10 years of zero, you're going to have a less income. Now, if you're still working, can some of these earnings that you're doing now replace some of those years that were less? The answer is yes. I'm making a lot more money today, so I'm putting in numbers that taking some of those lousy numbers out. Sometimes I have people come in, we look at their earning record, and I say, if you just work 2 or 3 more years, you're going to raise your benefit for the rest of your life because you're changing your overall earnings record. Now, if you're somebody who had the same job, made the same money for 40 years, this isn't going to affect you. But if you got some back and forth in there, but anyway, they're going off of your earning record. And here's what I think is funny again. I tell you about my friends in these stories. I grew up There's a lot of guys that were working in construction or home remodeling, and they got a lot of cash from customers. And we would get to the end of the year, and I know they would make like $150,000, but they would report on their taxes like $60,000. And then they wouldn't pay any tax. And it used to really make me mad. Man, they're beating the system. When they get into full retirement age and turn on their Social Security, are they going to get on the 150 they didn't report? Or are they going to get on the 60 they reported? On the 60 they reported. And these fellas are turning these ages now going, what is this? I go, you never claimed your money. You always were here. So it matters when you're contributing and doing your taxes to these Social Security reports. But anyway, that's how it works. Remember, PIA is what you get at FRA. People forget this, and when I start talking to you about this. Now, where do you find the information? You go online to the government website, ssa.gov/my account, those little blue buttons over there. If you haven't done this yet, you log in, you see and when you put all your information in, they're going to have your earnings record in there. They're going to have these dollar amounts that they're going to give you, kind of what your estimated Social Security benefit looks like. You're going to find your PIA inside of that account, and based on your earning records, they're going to print out what they call a retirement estimator sheet. Now, I'm going to tell you, this sheet is older, so your updated versions look different, but I use this one because teaching and educating helps. So based on your earnings record, they're going to tell you what is your PIA. In this individual here, at their full retirement age, they would get $2,370 a month. But if they went early at 62, they only get $1,600. And if they delay to 70, they're going to get $2,900. It's an 85% difference in money around from going early to going later. This may be something that you're going to have to decide is if you're saying, I need to increase my benefit. One of the ways to increase your benefit is delay. Maybe work a little longer. That's some of the things that you can do. Now, I'm going to explain to you how this works. So here's our 62 to 70 window. And what I'm showing you up there in FRA with the 0 is I say if you turn your Social Security on at full retirement age, I'm using a 0, meaning there's nothing added to your check. There's nothing subtracted from your check. If I'm going to get $1,000 at PIA, I'm going to get $1,000 at PIA. If my PIA was 66, I get $1,000. But that same $1,000, if I took it early at 62, I'm going to get a reduction of 25%. I'm not going to get $1,000. I'm going to get $750. And that's for life. You're going to get a reduced amount. Some people think, yeah, I know I get less, but I'm going to change that later on. You're going to change it? How are you going to change it? And then they're like, you can't change it? They're going, no, you can't change it. So just remember, when you claim, it's at your choice for life. Now notice if you claim 63, 64, the closer you claim your own benefit to full retirement age, less money is subtracted. And of course, if you claim at your full retirement age, then you get the full benefit. But notice if you're somebody who can delay and don't take a Social Security benefit past your full retirement age, that's an 8% increase each year. If you're at 67, then you get 3 years of 8%. But if you're like me, you get 4 years of 8%. I'm going to stop for a second. I'm in the investment business. I've got investments. I think I got pretty good investments. You got investments. Shout out the one you have that's 8% guaranteed for the rest of your life. I want to hear the one you have. This is a big deal. Now you have to decide, do I pull money in retirement from an account, maybe let my Social Security grow? Do I turn my Social Security on and save the money? And we have to make these decisions, and this is what I do every day, is try to help people with that. But do notice that it stops growing at 70. Those increases of 8% are called DRCs, Delayed Retirement Credits. If you're talking to Social Security and they're throwing that term out, DRCs, that's after your full retirement age. And you can get those, and if you turn them on, and by the way, they are prorated. So if you're saying 8% a year, and you turned it on only 6 months into the year, would you get a little bit of an increase? You would. They prorate that 8%. So again, every month that you delay turning on, you're giving yourself a raise in Social Security. But notice it stops at 70, and I'm going to make this point. I had a gentleman in my office. And we were talking, and he was 71, going to be 72 in like 2 months, and he didn't turn on his Social Security benefit. And again, I'm asking him, I'm saying, hey, Jack, how come you didn't turn on your Social Security benefit? He said, I'm waiting. My brother said to max it. I said, oh, your brother said to max it. Your brother? Yeah, he works in the warehouse down at Jewel. He said, max it. I said, when do you max it? He said, 72. I said, really? It stops growing at 70. So you don't get any more money. Now, here's the funny part. Social Security is not going to backdate those 2 years. They will give them up to 6 months in a lump sum, but the rest of the money, gone. Now, again, telling you, brother probably had all good intention, but when you are at a dinner party or you're at the donut shop and you're talking about this and everybody starts acting like they know what's happening, be careful. I tell my clients, I don't care what you hear, get in here. We're going to talk about this because when you make these decisions, it's life. You don't get to change. So be careful on that. It does stop growing at 70. Now, I'm just going to throw some numbers out here and say, if you were turning 62 this year, what could be your max benefit from Social Security? Look at that, $27.10. That's the max amount you could get if you were 62 this year. If your full retirement age is this year, $38.22. And of course, if you turn 70 this year, $48.73. That's the max benefit you could get. Sometimes why this is kind of important, and I'm going to tell you, if you start talking to me and we start going into retirement, we want to know your numbers, your PIA, early, late. We're going to start building the income plan starting with Social Security and some of these numbers. So we want to see your statements and we want to start talking about this. But when sometimes somebody comes in and says, hey, my full retirement money right now is $3,700. I said, well, you've almost maxed it. You did really great. Other people will say, my full retirement age, $2,100. How am I doing? Well, compared to $38.22, not so good. But anyway, it's just kind of nice to know. Now, next year in 2025, these numbers will be different, but there is a max benefit. No matter how much money you made, they always have a max benefit at these different ages. This hurts the high earners, not the lower earners. The people that are making a lot of money, they're the ones that are going to see the hit more than somebody that's in the lower end of this bracket. That's just the way that works. Now, I'm going to tell you this, and you've got to make sure you understand you heard this here. This is a warning for anybody that wants to turn on a Social Security benefit early and they're still working. And let me tell you how this goes. I have people, again, I'm going to tell you my golfing buddies, hey, Tim, I got a loophole on Social Security. And I always love it when my friends tell me this because I'm thinking to myself, I've paid money, I've gone to school, I've been trained. I don't know the loophole. What's the loophole? But my friend over there, who's over there delivering pizza, says, I got a loophole in Social Security. I go, okay, what's the loophole? And he'll say something like this. I'm turning my Social Security on right now at 62. I don't need it, but I'm going to invest it. Really? You ever heard stuff like this? I'm going to invest my money because we're smart. We're going to make more money. I had another guy that said, I'm buying a condo in Florida. I'm using my Social Security to make that payment. And I go, wow. Have you talked to anybody about what happens if you turn on Social Security early and you're still working? And they go, what? I go, penalties. Big time penalties. What? If you turn Social Security on early, this is any year before your full retirement age, you are going to be subject to something called an annual earnings test. I see this every single month in my practice. People have turned their Social Security on and they've gone over the allotted amount and then they got to pay a big penalty. So what we're showing you here is if you turn your Social Security benefit on early, there's a certain amount of money that you can make, and if you go over that number, you're going to pay a penalty. So let me explain how this works, because this is very important. This chart is in your book, but I want to focus your attention up here, because when people say to me, they go like this, they say, you know, if I turn my Social Security benefit on early, let's just use me an example. I'm going to say I turned my Social Security benefit on at 62. And that top middle box highlighted in yellow, how much can I make if I turn my benefit on early? $21,000 at 62. Well, what can I make at 63? $21,000. What can I make at 60? I'm sorry, $22,000. $21,000 was last year. I can make $22,000 a year. That's it. If I go over, I pay a penalty. Well, what can I make at 63? $22,000. What can I make at 64? $22,000. What can I make at 65? $22,000. You see how this goes? What can I make at 65 or 66? The year I turn 66, remember I'm 66 in 4 months. The year I turn 66, well, now I can make $59,000. A little better. But again, if I'm over, I'm a penalty. But look at that bottom box. If I turn 66 and 4 months, there is no earnings test. In other words, I can make $1 million and there's no penalty. So what I want everybody to think about, if you came to see me and you said, Tim, I want to turn my Social Security on early, our first question is, are you still working? And if you are, we say, let's bring it to your attention. If you say, no, listen, I'm going to retire, well, then it's different. Now, I'm going to tell you something here, and a lot of advisors don't understand this. And again, I'm just telling you because whoever you're talking to, I see a lot of mistakes. So look in the top left-hand corner there. What counts on the earnings test? Well, wages, any earned income, but look at that, commissions or net profits from a business. I've had people come in when I start talking about this earnings test, why did you turn your Social Security on early? You know, you're still working. He goes, no, I'm a commission. I'm a realtor. My other advisor said it doesn't count. No, it counts. You're going to get a penalty. It counts. Does your advisor understand? No, he doesn't understand this. We didn't train for this when we got all our securities license and stuff. They're not teaching us Social Security and Medicare. We have to learn this through a different way. But anyway, net profits from a business. I have people, fathers, that have sold their business to their children. They don't even take a paycheck anymore. But the business makes money, and all of a sudden they got some income from the business. Does it affect their Social Security? Yes. This is only if you turn the income on early. This is only if I turn my income on early. It's my earning. It's not counting my wife's earning. It's counting my earning. If my wife turns a benefit on, we're looking at her earnings. But if I turn 66 and 4 months, we don't worry about the earnings test. There is no penalty. In the black there in the middle, what does not count on the earnings test? Well, IRA distribution. So what the government is saying is if you retire early and you turn on your Social Security and you're pulling money out of an IRA, taxable, but it doesn't count on the earnings test. Okay, pension, taxable, doesn't count on the earnings test. I thought this was interesting. Rental income doesn't count. Look at this, lottery winnings. We had an $800 million lotto last night. And I was thinking about this. You know, in this Social Security rules, you can only make $22,000. Oh, if you won that $800 million, that's fine. That's okay. Who makes these rules? Anyway, that's how the system works. And then sometimes stock options and severance packages could affect your Social Security. This I see every month in my business. Now, I'm going to give you an example of something that happened to a client of mine, but I could give you 25 of these examples. Now watch this. This is a client of mine. And I remember when she came in to see us and she said she was retiring at 62. Now she's got some money, but she was a law clerk downtown and she makes way more than $22,000 a year. And I remember talking to her and I say, you're going to retire, you're going to still work. She goes, yeah, but I'm going very part-time. I'm going to keep under the earnings. Says, I understand all that. Or maybe I'll pull money from my other accounts that don't matter. And this is, again, as an advisor, if you have different accounts, we tell you which bucket to pull from that doesn't affect the earnings test and so on and so forth. So she says, I'm good, and everything was good. So we went and doing this for a couple of years, and I think she came in at 64, and we're doing her annual review because we're managing her money and doing things. And in that meeting, she says something like this. She says, oh, and by the way, and again, she points at me like it's my fault. You got to find out what happened to my Social Security check. I started laughing. I said, what did I don't have nothing to do with your Social Security check. She says, I haven't got a Social Security check in 9 months. And I said, oh, no. Are you still working? She said, yes. I said, how much are you making now? She said, I don't know. She said, probably more than $22,000. Well, yeah, I'm picking up overtime in here. Well, watch this. She made $63,000. She can only make 21 at the time. 21 was the earning tax. She's 42,000 basically over the number. What does that mean to her? She's got to write a check and pay $20,000 back. How many know about this? This is not talked about, but maybe you've heard about this. And by the way, this is another one of those new rules. They're trying to push people back. They're trying to save money. If you're going to keep working, this is what they're doing. But here's what happens. If you don't pay that check, they turn off your Social Security. They stop it. This is called an involuntary stop. And I want you to understand something. When they turn it off, your advisor, even the Social Security credentialed guy, we cannot turn it back on, nor can you. You are going to sit there, and for the next 2 years, because her full retirement age was 66 and 4 months like me, she has to wait 2 years and a half before that Social Security benefit will get turned back on. Luckily, she had money, but if you don't have money, this could affect you. Now, what happens is all these months that she didn't get a benefit, they're going to consider all of that money and they're going to recalculate a new benefit to her and they're going to turn it back on at her full retirement age. She will get her money. I'm just saying she's not going to get paid for 2 years. That, in a different situation, when somebody's living on Social Security and that's all the money they got and they just hopped a little job and they made too much money, that money gets turned off for 2 years, that is devastating. And nobody told them that. So I want you to be aware there is an earnings test that could affect you. Again, if you're at your full retirement age and you're collecting Social Security, no earnings test. Doesn't matter. And again, this is on you. Whoever is collecting the benefit, it's your earning. People will say to me all the time, does my spouse's earning count? It does not, okay? It's on your earning, but keep careful about that. Let's move to spousal benefit. Now we're talking about if you're married. Me and my wife have been married 43 years. I have a Social Security benefit. My wife has a Social Security benefit. But we have some options here. As a spouse, you can either claim your own benefit or half of your spouse's PIA, whichever is more. So again, if my wife, who was not working most of her life because she outside the home, she was raising our children. So her Social Security benefit was very low. Half of my PIA is way more than her full benefit. However, I can't file and suspend anymore. The rule is I've got to turn my benefit on first for her to come in and collect. So I have to be collecting. We actually had this conversation. My wife said, come on, I want some Social Security money. I said, wait a minute, I'm way over the earnings test. If I turn mine on, you don't understand, turn your own on. That's actually what happened. So when she turns her own benefit on, she's going to forfeit the half of the PIA. Or if she takes my half PIA, she's going to... So if I was getting $2,000 a month, I get my 2 and she would get $1,000. How the spouse gets the full 50% is she has to be he or her full retirement age when she turns it on. So if I was getting 2 and my wife wants $1,000, she has to be at her full retirement age. If she claims the benefit early, she gets a reduced amount. And she's subject to the earnings test. What? Every time you turn a benefit on early, subject to the earnings test, reduced amount. And if your advisors, again, don't know this, somebody needs to be coaching. You need to be with somebody. But anyway, that's how that works. I'm going to give you an example here. Susan and Tom are married. Now remember those DRCs, those extra credits, this is where it gets confusing. So let's take a look. Tom's PIA, $2,400, but he's collecting $3,000. Why? He delayed. His PIA was $24,000, but he delayed a little bit, so he's collecting $3,000. His wife, Susan, is at her full retirement age, so she says, I want half. Does she get half of the $2,400 or she get half of the $3,000? She gets half of the PIA. This is another confusing part. If I had $2,800 on Social Security benefit and I delayed till 70 and now it's close to $4,000, my wife doesn't get half of the $4,000, she gets half of the PIA. It's always the PIA. Now, can I show you something in this example? And I'm going to show you a couple of things to start building your income in retirement, which nobody's talking about, but you're going to hear this from me. This person, this couple, has $4,200 in Social Security income, correct? And they're filing joint, which means a lower taxes. So keep an eye on something. I want to come back to this. Ex-spouse works the same. If you've been married for at least 10 years and you get divorced, you are going to have an option to claim your own benefit or half of your ex's PIA. even if your ex got remarried. What? Unfortunately, I see a lot of this. I have a lot of ladies sometimes that come in and they tell me, I was working, raising children. I don't have a very high benefit, but my ex-spouse over there has a much higher benefit. I want to claim half, but he's already married. And I say, this is how wonderful this works. If your ex is getting $2,000 a month on PIA, he's going to get the $2,000. His current wife gets $1,000. You don't affect any of their money. You also claim and get $1,000. What? Everybody that can do this can get this. Now, are there family limits? There are. But if you're an ex-spouse, I tell people, they say, I don't want to make trouble. I don't want to go in and make trouble. I say, it doesn't affect any of their money. None of it. They get everything coming to them. You are going to get your money based on the time you were married, and it does not affect them. Now, here's the good part. They changed the rule on this one. Your ex doesn't even have to be collecting. Remember, you get an ex, when you get a PIA spousal benefit, you have to have the spouse collecting. They changed this rule a couple of years ago because in divorces, it became spiteful. And people would say, I'm not turning my benefit on, just to get you. So the government came in and said, wait a minute, we don't even care if they've turned it on. If they're eligible, you're going to be eligible. So if you have an ex-spouse and you need that money, you should come talk to us. We'll show you how to get that. But that is a good rule that's in place. Now, if you remarry before 60, I want you to know this. I have a lady, she's 59. She's divorced, but she's in love. And we're talking about this right now. And I said, listen, hold on before you get married. Why? I said, because if you can hold on to 60 and you marry a new guy, you get to say, what do you got on the PIA? And if it's not good, you can still claim on the ex. But at 59, you're going to... But anyway, we're having a conversation like that. Let's talk about a deceased spouse. And again, I see a lot of this. I've got two spouses collecting Social Security. When one person dies, what happens? Anybody know? The surviving spouse gets the higher of the two, but not both. They're going to lose one of their benefits. So let's look at our example again. Here's Tom collecting $3,000. His wife Susan's getting $1,200. They're making their $4,200. Tom dies. Susan gets Tom's full benefit. This is the good news. But she loses her own. If I was getting $3,000 at PIA and I delayed to 70 and now it's $4,500, when I die, my wife gets the whole $4,500, but she loses her own. This is one of the reasons, if you're working with me, sometimes we have in a married couple, maybe one person claim early and the other person claim later because we're trying to get a higher death benefit if we can. Sometimes it works out that way. Here's the tragedy to this, and I want to show you, and again, I'm going to talk to you about this because I see this. They're making $4,200 filing joint. Now she's alone, she's making less money, $3,000, and she's filing single. What is happening? She's getting less money and taxes are going up. What? And now I got inherited IRA money, or I got taxable money here. We see, if you don't plan this out, this is devastating for people. And I will tell you, I spend a lot of time talking about, if we're working with a couple, when one of us dies here, we got to make sure we've got something in play. If I have a single person, I'm trying to say to somebody, what happens to your money when you die, or who gets it? Because there are some things that you have to plan for upon death. But I see this one, money goes down and income goes up, and this is tragic. So be aware of that's there. You need to have a plan for that. So a deceased spouse, if you have somebody and you're married and you have a spouse that died, you are the only person right now that can make a switch. In other words, if I had a deceased spouse, I could go collect my deceased spouse income from Social Security now, allowing my own to continue to grow. And maybe on later on, I'm going to say, forget that spouse, and I'm going to collect my own. So if you do have a deceased spouse, you are somebody that still has a switching strategy, but nobody else does. Again, you have to be 60 years old to claim on a deceased spouse. And I have a lady right now that I'm thinking of, 58, she needs this money, but she can't get that benefit until she's 60. But her choice is going to be claim on her deceased husband's benefit first, allowing her own to grow, and when she gets to 70, she's going to switch to her own because she can still do that. Again, if you have an advisor who understands this, we can help you. These are a couple of offset provisions. I don't want to spend a lot of time on this, but WEP, these are provisions if you worked for an employer and they were not contributing the full amount to your Social Security benefit. A SERS worker, if you're a federal employee, would be an example. Teachers sometimes, they're contributing to a teacher's pension. They're not necessarily contributing to Social Security. So what ends up happening is they could have these government offsets or these WEP, and all that says is there could be reduced amounts. And I've had a situation where I have a teacher that was a lady that has a very high pension from a teacher, and her spouse died, and when she went to go collect on her spouse's Social Security did not allow it because she makes too much money on her pension. She had that government offset provision in there. You need to know about that if that's somebody that. Does this happen in every situation? It doesn't, but it could happen. You're counting on some money that may not be there. You need to know that ahead of time. So that's just a little bit about that. Let's talk about taxes. How is Social Security taxed? Some people think they're not taxed on Social Security. Now I'm going to show you that you're paying Social Security federal income tax. No Illinois state tax. I can't even believe I'm saying that. Illinois is taxing, well, exactly what she said. Currently, Illinois is not going to tax your Social Security, or they're not going to tax your retirement money yet. Other states, federal and state, but in our case, we're only talking about federal income tax. Now, the good news about the bad news first, your Social Security is taxed at ordinary income. That's the highest rate. That's the highest rate. Whatever your income rate is in retirement is what you're going to be charged on your Social Security. But they give you this break. It's based on this provisional income formula. And what's good about this is where if you're an advisor, we can start playing with this a little bit and start mitigating some taxes. So I want to show you a couple of things here. So first of all, let's look at a married couple. They're making $30,000 apiece on Social Security only. That's $60,000. Everybody see that? But when we go to file taxes, we only have to report half. So they make 60, but they're claiming 30. And then when we go look at this federal tax bracket, we look in the top right-hand corner and say, if you're married and you make less than $32,000, if this was only Social Security, they would be in that top bracket. They make less than $32,000, they pay zero income tax. On $60,000 of income, they pay zero. Now, of course, if you're taking more money in and you've got more earning, you're seeing that more of your Social Security becomes taxable. 50% does, 85%, that's not an 85% tax. That's 85% of your benefit. If I made $1,000 and I was in that higher bracket, 850 of my 1,000 slides over into the taxable column, and I pay income tax on that. But Social Security is the benefit that we can get some tax savings on if we know how to use that. So again, we're talking about federal income on that. Now I'm going to show you, and again, this is an example of a couple of little moves that we do as advisors that make a lot of difference in people's money. So watch this. I got that married couple that's making, $60,000, but they're claiming 30. So their Social Security benefit's 30. But you know what? They had a CD, $100,000 in a CD. They made $4,000 interest that year. So that put their provisional income into $34,000. Oh, wait a minute. Now I got to pay interest and taxes on the gain from the $4,000. On top of that, I now got to pay 50% on my Social Security tax just on that one little thing. Oh my goodness, this is crazy in retirement. You come to me and I say, wait a second, we're going to change this. We're going to take that $100,000 CD, and we're going to put it in an income product, an investment product that's tax deferred. This could be something like an annuity. The money is tax deferred. So what happens is you're earning the income, but you're not getting the tax. You're still making your 4 or 5% or whatever you're getting, but you're not getting the 1099 for the taxes. What does that do? It brings your provisional income down below, and now you're saving money on Social Security and you're saving money on that tax. If somebody doesn't know what they're doing, you're going to pay a higher tax, and this is going to go on for the rest of your retirement income. So you need to be aware of some of the things you can do there. Now, I'm going to leave you this. I can't tell you how many people, and it's more than I care to tell you, I've seen people and they do not know how to claim their benefit. I've seen people, I say, why did you not turn on your Social Security benefit? They go, and embarrassed, I don't know how. I thought they were going to call me. I thought I would get something in the mail. So I'm telling everybody, because it's your money, they're not going to call you, and you're probably not going to get something in the mail. You're going to go online to ssa.gov, that's on the back of your workbook, and you're going to apply. Or you're going to call the Social Security Administration office, or you're going to go in and meet with somebody, but you actually have to take an action to claim your benefit. So when you're ready to go, you do that. Now, I'm going to tell you this in closing on this section. When you do turn on a Social Security benefit, you're going to have some other options that Social Security is going to ask you. Number one, they're going to say, do you want to withhold any taxes on your Social Security benefit? Because you might be somebody who's making money, you're going to have the option to pay some withholding out of your Social Security benefit or not. That's up to you. The second thing they're going to say to you, we want to take your Medicare Part B out of your Social Security. Do you absolutely have to do that? You do not. That's a choice. If you decide, give me my Social Security, I will take my Medicare Part B separately, that's again up to you. Or you could say, yeah, just take it out, let's just do it all in one. And the last thing there is they sometimes offer you, if you're somebody who went past your 62-year mark, they're going to say, hey, listen, we can give you a 6-month upfront cash benefit. You're eligible for $2,000 a month times 6 months. We'll give you $12,000 upfront if you want. And I've seen people say, give me the money. And I'm going to say, sucker bet. Why? Because what happens is if you've delayed your Social Security enough to make some extra money, and you go back and claim that benefit and take that $12,000, it puts you back here on your benefit. You are now going to make the lesser amount for the rest of your life. You took 6 months payment to sacrifice the rest of your life. Sometimes it makes sense, sometimes it does not. Just be aware that, yeah, you're going to get the money, but when you take that money, you're going back to where that benefit started. So keep that in mind. That's enough about Social Security there. That's kind of the review. I just want to kind of move along here on that. Remember, count half your income. You all have to make a decision when to claim. Let's move into Medicare, Section 2, Medicare Part B. Now, Medicare is very confusing today. And if we've got people around 64 years old getting close to Medicare, you are getting blown up with mail. You getting phone calls. You are getting solicited on Facebook. You are getting... Listen, Medicare today is so doggone confusing. When I have to certify to do these different Medicare things, it's a circus. I don't know how people can try to do this on their own. So I'm going to explain a couple of things to you. There are penalties associated with Medicare Part B and Part D. So let's start talking about Medicare Part B. And I'm going to share this with you. And the reason I want to explain something to you is in my business, I am certified for Medicare. We do Medicare for our clients. We offer Advantage plans, drug plans, supplements, all different kinds of programs for our clients. And I want you to know, if you buy Medicare from me, or you go buy it online from United Healthcare or Blue Cross or wherever you want, you're going to pay the same money. So you don't get any break by going direct. The break you get with a broker or an advisor is now you can come to me with questions. If you're with Blue Cross and I'm not your representative and you want a question with me, I can't help you. But the incentive is I get a commission every time you make a Medicare payment. So you have salespeople out there hawking you, and they want to get you into Medicare, and they are going to use pressure, and they're going to use this I'm about to tell you as one of the reasons in scaring you to do this. And I'm going to tell you, don't fall for this. So let me explain what happens. When you're eligible for Medicare is 3 months before you turn 65. Then the month you turn 65, and then 3 months after. There's a 7-month window here. They call this the initial enrollment period. Why is this critical to you? I'm going to explain. Let's say I'm covered at work over here. My insurance I've been on at work. But now I'm getting ready to turn 65 and I'm going to leave work and I'm now going to go over to Medicare and sign up for Medicare. What if I have a pre-existing condition? I have cancer and I'm leaving this plan and now I'm coming over here to Medicare. Am I going to be underwritten? Am I going to get it? Am I going to get qualified and all this? Well, during this window, Medicare says, come on in, no medical questions. That's the benefit of joining Medicare during this window. Now, if you don't have any insurance and this window goes by and you're 10 months with no insurance, when you do come to Medicare, you are going to pay a penalty for Part B and you're going to have penalties because you missed your window, and now you are going to be underwritten. So it's a very critical window. However, if you're still working, I'm 68 at work, let's say, I'm still working, and I'm covered at work. And when I leave work at 68 or 69 and I come over to Medicare, I'm getting a brand new window. The window always goes when you're coming to Medicare. The only thing that we ask you is if you come and see me at 68 and say, I'm going to sign up for Medicare past 65, I say, did you have coverage at work? Yes, I did. Here's my certificate from work. No penalty. Come on in. This would apply for me working and my wife who's not working but covered by my work insurance. When we leave work, we are going to come to Medicare together and we're going to get this brand new open window. So that's how it works. But salespeople are going to call you, oh my gosh, you're 67? Oh my God, you're going to lose the window. Did you know that? Come on, I got to help you. And people get scared and they sign up and they start going through them and they get on Medicare and now you lose your company program. Sometimes it works out because maybe Medicare is better, but sometimes your work plan is better and you lose it. So I'm just telling you, we do get commissions for Medicare, but the motivation be your interest. I'm doing this to help you, not me. So again, if you're working with an advisor and they're talking about Medicare, when should you sign up? If you don't have any insurance, sign up during that window. If you're working and you're covered at work or your spouse covered at work, don't worry about it. Everyone's going to call you, everyone's going to scream at you, everyone's going to scare you. You just sit there and wait. And at the end, when you come to Medicare, you get the same window. It all works, no problem. Medicare Part B has what's called the IRMA tax, extra tax for Medicare. I hope you can read that chart, it's far away, but what we're showing you is Medicare Part B starts out at $174. Now we're looking at two columns there and saying if you're single and you make too much money, or you're married and you make too much money, are you going to pay extra for your Medicare Part B? And the answer is yes. And you look down there, if you're married and you make, as a couple, between $250,000, you're going to pay an additional $174 on top of the $174. Your Medicare Part B is double. I've seen people up here at $500, $600 for the same Medicare people are paying $174 for. And they'll go like this, we don't even make the money. How did this happen? This is a 2-year look back. So watch what people do and how this gets there. Again, no advisor or wrong information. People will say to me, Tim, when I was retiring and I was signing up for Medicare, before I left work, I took $150,000 out of my 401k and I paid off my mortgage. I didn't want to have a mortgage on my house. I said, I understand why you did that, but that $140,000 was on top of the money that you made. You just put yourself in that bracket for the next 2 years. What? When you start taking an RMD, a required minimum distribution, some people are taking, could this affect your Medicare Part B? Yes. What? You pull this lever, this happens. Anyway, I'm telling you, it's more complicated. Now, how this works is you don't do anything for this. If you file a tax return and you're above this, you're going to get the bill for the extra charge. I do. I'm on Medicare. I'm not on Social Security. I'm somebody who's paying double for Medicare because I'm in the higher bracket. What's going to happen when I retire someday and I fall in a lower bracket? When I go through 2 years and it's out, then that payment's going to drop off. And then you're going to go. So it's going to be based on your tax returns and it's going to come on and off. Medicare Medicare pays the bill and then you get this thing for the extra charges. IRMA. Income related. That's what it is. When you start taking income in retirement, and if you don't have somebody who knows what they're doing, it's going to start affecting IRMA. Once you have Medicare A and B, then you're going to have an option. I'm not going to do a Medicare seminar today, just going to give you an idea. You're going to add to your Medicare A and B either a supplement and a standalone drug plan. That's how you cover yourself in Medicare. Or you take Medicare A and B and you take the blue version, which is an Advantage plan. It's kind of an all-in-one plan. This is the one that Joe Namath is on TV. This is what you're going to see on this open enrollment period that's going to start coming in October, and your whole TV is going to blow up. These are the Advantage plans and the prescription drug plans. You can only move in and out of these plans at a certain time. I just want you to understand the supplement is different than the Advantage plan. 21 different companies in Illinois offering Advantage and supplements. You need to shop a little bit and find out, are you better with a supplement, or are you better with an Advantage? I would recommend find a broker, somebody like us, that does both, and then you can hear that. If you call United Healthcare, what plan do you think you're going to hear about? If you call Humana, you're going to hear about Humana. If you talk to somebody who's a broker, then you might get some information. But it's very confusing today, and you do have a lot of options. So just kind of end that with that. Let's do the last section here, and this is probably going to be the most important. I'm going to tell you some things that I'm doing with my own clients, and I'm going to tell you ways I'm helping clients, and I'm going to show you some mistakes that are happening that could happen to you too. So again, keep some notes on this, get the idea. If you like what I'm saying, talk to your own advisor. At the end of this, if you go, I got to come and talk to you, I would welcome that, but I'm going to show you some things here. So my retirement strategies that I use with my own client, how do I set up a proper income plan that people can rely on? What about tax saving moves, when and how to do that? And then how do you make your money work in the up and down markets? Because we're going to have this in retirement. So I'm going to show you a few things. Keep in mind, I notice a mental thing that happens to all of us when we retire. I watch people retire. They had identity at work. They had a purpose they were doing, and some of them liked their job. And now the job is over, and they sort of have to kind of adjust to life and what's happening. I had one couple say to me, when her husband said, "I'm home forever, I'm here with you," and she said, "Oh my God," that kind of stuff. But you have to make an adjustment. But when the employer paycheck stops, this is different in your head. That money stops. Okay, that's different. And then you say, well, wait a minute, now I got to get off my employer insurance that I'm so comfortable with, and now I got to go to Medicare, and this is all different, and this is new, and nobody showed me this yet. And then you go, wait a second, I've been contributing to this 401k out of my paycheck, and now I got to say, well, I got to roll this to an IRA, and I got to start taking money out and paying tax. This is way different than just These are all things that you have to start dealing with, and it gets a little more. I got to claim Social Security, but when should I claim along with this? All this. And then you're going to start all these different buckets of money. Where are you going to pull money from first when you have all these different accounts? What I'll tell you is this is shocking to a lot of people. And if you have an advisor that's been managing your money in some kind of a stocks and bonds portfolio along the way, and now you're moving into retirement and it's different, they may not understand this at all. We do this phase a lot. You are moving from what's called an accumulation phase you've been doing in your life. You're stopping, and now you're going into a distribution phase. And I even say this to my young advisors on our team. This is different than when you're here. When you get to this phase, this is a lot different. We have to be a lot more sensitive, and we have to point out a lot more things when people are getting into retirement. If you're talking to me, the first thing I'm going to want to know is a little bit about your expenses. What do you have to cover in living expenses when you go into retirement? That's the first thing. And then we're going to say, let's look at the different sources of money you have. You might have Social Security, you might have savings, you might have a pension, you got a 401k. Let's start listing all of this out, because we're going to use all of these sources as part of your income. And what we end up finding is sometimes people have all kinds of different accounts. Could be TOD, could be joint, could be IRA, could be Roth IRA. What I'm here to tell you is those are tax different. Those are contributions different. There's a lot of differences to these different kinds of accounts. They are not all the same. We as advisors don't even put the allocations and investment the same in all of those different buckets. We want specific investments for these different types of accounts because it matters. And I'm going to show you some things that we do. Now, first thing I want to tell you is when we're talking to you about retirement, I'm going to say to you, all of the money that you've saved your whole life, We're going to go into retirement, and you got to make this money last in the bull and the bear market. I put these little pictures in here one time because I said, what about bull and bear market? And I had this really sweet lady in the front row. She said, the bull and the bear, which is the good one? So the bull is the good one, and the bear is the bad one. But how many know you're going to have these up and downs? If you have an advisor that says, I know how to time the market, I'm going to make sure I think that's a lie. I don't believe we can do it. I would tell you I can do it. What I'm going to tell you if you come with me is we're going to have some bad years. Well, look at this, 2022. That was not a good year. We were all losing money in the market. Then we come back 2023, oh my goodness, this starts rebounding and we're doing fantastic again. And all these different indexes are making all kinds of money, and here we go again. The one thing I share with people up there is if you look at S&P 500, just to give you an idea of different index, that's 500 US-based companies. There are no international companies in there. And then if you look at the Dow, 30 companies. Could some of those companies be the same in both indexes like Microsoft? It could be. But if Microsoft had a bad report or something and you're in the Dow, 30 companies, does it affect the Dow more than the 500? Yes. So when we start talking about investing, we have to kind of look at this. If we go into something like the Russell, thousands of companies. NASDAQ is all these technology stocks. These are on fire today. But are they risky? Woo-hoo. Now, here's all they call this the Magnificent Seven, all this artificial intelligence. If you own a fund in your 401k, you have some of this stuff, you've been seeing a lot of growth in the market, and you're over there pounding your chest, great. Are they volatile? Oh my goodness. We've got an S&P at 5,500. That is a high. In my lifetime doing this, I've never seen it that high. But people ask me, is it going to hold? I don't know. You think in retirement the market just keeps going and going and going until you die. Could it be like this? Yes. When your accounts are losing money in the market and we have to liquidate something now to take a distribution out, we're going to compound your loss. And money is going to disappear faster. And this is a reality of what's happening to everybody. So why do we want to talk about risk in retirement? It's something like this. We're looking at a chart here that shows somebody who has $1 million. You see that at the top. And they're going to take $40,000. Our advisor rule sometimes is 4% is the safe withdrawal amount. So we're thinking, hey, if you're pulling 4%, that should last 25 years in all markets. Really? Here's $1 million taking 40 grand out a year. And you notice that this particular person got unlucky. The market dropped the first 3 years in retirement. Look at how much money in 10 years. 2/3 of their $1 million disappeared in 10 years. What? And if an advisor doesn't make any correction with you there and doesn't change this, you don't recoup these sometimes. So it's very critical now to say, wait a second, when the market is falling and you're pulling money out, it's going to compound the loss. So this is a problem. And even in our little, when we're going through investor and financial school, we talk about an equity portion of your money and a bond portion of your money to try to offset and kind of mitigate this. And usually when we tell people a 60% equity position and a 40% bond position, that's considered kind of a conservative model. Well, that conservative model lost 17% in 2022. What? We're in a very weird situation right now. We've got interest rates rising and inflation rising, and if you have a bond portfolio, that's going to affect the bond portfolio. We've had people come and see us, their stock portion is losing money and their bond portion is losing money. How can this happen? I need the money, I'm not working anymore. This is scary when you're not working. And I say, you got to get out of this model. We're getting out of this. We're not in this model for you in retirement. So what I'm going to tell you is we're going to get out of this. Otherwise, we're going to say, just let it ride. You'll be fine. Yeah, it's down a little bit. No, let's get out of this. Because we're going to do something a little bit different. And what I'm going to tell you, if you work with me or anybody on my firm, we are going to prepare for these market crashes. We are not going to have people panicking. And how we're going to do this in our world is we're going to set up a couple of different buckets of money. When I get people to come in and see me, they kind of start like this. Tim, I want 100% I want the investment that gets me the most gains in the market. Oh, but then I want 100% protection if it goes down. And then I want it 100% liquid. And I laugh. I go, we don't have that investment. There is no Swiss Army knife. But here's what I'm going to tell you. We accomplish this by different buckets of money. We might have a bucket that has 100% protection. Is that the bucket that's going to get 100% gains? No, this bucket's going to get the 100% gains. And if this market is down and you say instead of pulling money out of the loss bucket, I'm going to say don't touch that bucket because we don't want to take the loss. Let's go to the bucket and pull the 40 grand this year out of that bucket, and then let's let this one rebound. And we kind of do it this way, and we accomplish this with different buckets. If your advisor just has you in the stock and bond portfolio, or maybe you're all stocks or whatever you are, well, you're taking a lot of risk, and I'm just telling you, you might be in for a rough ride. I tell my clients, we don't want all your eggs in one basket. If you come to me and you had $500,000 in a 401k, I'm going to split that money into a couple of different buckets. We are not going to have all that money in the market. We are not going to have all that money here. And we're going to accomplish the plan for you. And we're going to talk to you about which bucket we go from, but we're not going to put it all in the same bucket. You might have a couple of different buckets with that money. You might have a stock bond, a bucket bond, a structured note bond, or a barrier ETF. These green buckets offer protection from your account. Indexed annuities, IULs, there's MYGAs, there's lots of things out there that have protection in the market along with your stock. Do I want all your money in an annuity? No. Do I want all your money in the market? No. Do I want a blend of this? Yes. Because we find over time when the market's up and down, my people are not panicking. You don't understand the panic when you're not getting a paycheck and you got all that money and you start watching this. This is going to scare you more than when you're working. I want you to say, yeah, the market's down. We're not touching that bucket. Leave it alone. And people can get this. But if you're not in different buckets, you're going to take the hit. Again, there's that thing where I'm going to tell you 4 times in that 10-year period, my clients would be pulling money from one of the volatility buffer buckets, the money that didn't lose. So on a 10-year period there, maybe 4 times we drew from another account. We didn't take that loss. They say, did you beat the market? I did not. People come and see me. I have some wonderful investments. We have stock market returns in the NASDAQ that are over 40%. It's been fantastic. Is it going to hold? I don't know. We don't know, but we don't want all our eggs in one basket, especially in retirement. This is how we do this, and we've been very good about this. These are some things out there, structured notes, MYGAs, indexing accounts for annuities or life insurance. These are the investments that are these volatility buckets. If you have an advisor that doesn't offer these kinds of products, well, then you're not getting the offers of protection. In my business, we're independent. We have a lot of all the options in the stock market. We have a whole complete line of insurance and other products. We can go in and out. If I work for Merrill Lynch or Morgan Stanley or one of these Edward Jones firms, I can only work with the investments they have. They don't have the full gamut that an investment independent person has. So you might want to shop around a little bit and say, what's the best for you? We look at this fixed indexed annuity, and I'm going to tell you that if you've not seen an indexed annuity lately, you're missing something. Because yes, the stock market is at an all-time high, but these annuity offers today are incredibly attractive. Why would you maybe want some money in a fixed indexed annuity? Because the money that you put into this product is not invested in the market. You're going to put money into this company, but you're not going to be invested. You're going to be able to grow that money, and I'll show you how you grow money, and then maybe you can turn money on an annuity into a guaranteed income like a pension. So if you tell me I need $6,000 a month in living expenses and my Social Security is $4,000, and I take some of your other assets and I build another $2,000 or $2,500 a month guaranteed income and tell you you got $6,500 coming every month. Now let's talk about your other investments. We use the annuity to do that because the annuity says when you're taking $2,000 or $20,000 or $30,000 a year out of these accounts, it's subtracted from your account. Eventually, if you live a long time, the account goes to zero but the annuity has to continue to pay you that money until you die. There's a safety to this. Now, if you die early and there's money in the account, they give that to your family or beneficiaries, whatever. But people want a peace of mind knowing they have this. If I've got your money in a stock account, a brokerage account, and we run out of money in that account, you're out of money. So I want a bucket that maybe has some guarantees to it. Now, you can also use the annuity to just grow your money, defer the taxes, and pay this. Today, we've got incredible offers. Some of these annuities are offering 15, 20% bonuses. The banks, the stock market brokerage, and the annuity insurance companies are all competing for our money. And they're all throwing these offers out. We just came off CD rates, the highest we've ever. I had CDs at 6.75. What? I've been doing this a long time. I haven't heard that in, 15 years? Now they're dropping. But these rates, sometimes you could take advantage of this. If you're somebody who has an old annuity, maybe it's older, and you bought this when the rates weren't that great, I'm going to tell you, think about a mortgage. Maybe you bought a mortgage at a higher rate. There's better rates today. Can you refinance? Yes. You have an annuity. It's not performing well. It's not one of the better ones. Can I surrender that and go into a better one? Yes. We look at doing this because it's your money and we want to make it last in retirement. So anyway, we do a lot of this stuff. The annuity, you can play the market with none of the losses. Now, this is my chart. People say, how is that possible? So I'm going to show you the red line would be the stock market, and the green money would be your money in an indexed annuity or an indexed life insurance policy. These are not whole life policies. Your money is not invested. You are linked to an index, but you are not tied invested, meaning what happens? You get in an index account, and the day you get in, the S&P might be 5,500. And we're going to track that S&P index for 1 year. And if that index at the end of the year, 5,600, you're going to make money. And the money in this account is going to get locked in. But what if you did 5,500 and next year it dropped to 4,500? Well, you don't lose a dime. You're going to sidestep the loss, and then you're not going to make any money, but they're going to reset the index down here. And as soon as the market comes back, oh my goodness, you sidestepped the loss, you didn't lose any money, and then you made money. Oh, what? I can't do that in a stock account. I can't do that with bonds. Do I want a bucket of your money over here? I do. So look at that. The red line goes up. Now, this account is not making all the gains of the market because you're taking none of the risk, but you are making gains of the market when the market goes up. Look at the red line drops 2. Look at the green line stays level. You didn't lose a dime. The red line starts bouncing back, you start making money again. This is hot today. Maybe not a few years ago we weren't doing a lot of this, but today you should be looking at these, especially for retirees. Anyway, if you're interested, you come talk to me about that. We're going to talk, the last section here is going to talk about taxes and qualified money. Qualified money is the term for money that you've been putting away for retirement that you have never paid tax on. So think about 401k. Anybody in here have a 401k? You know what I'm talking about? Okay. So think about a 401k. When you were contributing out of your check, were you paying tax on that money? No. Your employer might even give you a match. Did you pay tax on it? No. It's grown over these years. Have you paid tax? When do you pay the tax? Who knows? When do you pay tax on that money? You ever pay tax? Pay tax when you take the money out. Ordinary income tax rate, highest tax rate. Do you think this is on purpose that the government is adjusting tax rates right now when trillions of dollars are in these qualified accounts that we're going to have to start taking? I don't think it's an accident. I think tax rates are going up. And I think that's a little bit on purpose because we need money. But qualified money is different than non-qualified money. Non-IRA money is considered non-qualified money. That's capital gains tax. You think about capital gains tax. I want to put something in your mind that you understand. Let's take a house, for instance. Let's say I bought a house for $200,000, and I lived in it, and when I passed away, the house is worth $500,000. So there's a big gain in there. But if I pass away and my children inherit my house, they're not going to pay any tax on the gain. They get what's called a step up in the cost basis. Now, if they got the house at $500,000, I only paid $200,000, that $300,000 is profit to my children, no tax. Unless they hold on, they say, look, we're not selling Dad's house. Let's rent it. And they're going to rent it for 2 years, and now they're going to sell the house for $600,000. Well, they're going to be responsible from the $500,000 they got it to the $600,000. This works the same way in stock. You bought Apple stock or Microsoft or any of these companies, you got a $100,000 stock account, and when you died, it could be $1 million. And if you die, your children inherit that with no tax. What? There's a step up in the cost basis. So I'm just saying this. When we have non-qualified money, we're having a different tax talk. When we have a qualified account, a 401k, that when you leave work, it's an IRA. This money, if you die and give it to your children, they still got to pay the tax. You got to pay the tax, they got to pay the tax. Ordinary income, you don't get out of this tax. That is a different animal. So we're going to talk a little bit about what you have. When people walk in and see me, they go, hey, Tim, I got $1 million in my 401k. I say, hey, and I'm telling you, I'm impressed that you saved $1 million. How much of that is yours? What? Yeah, what tax rate will you be at when you pull it out? And will the government change the rules on how the taxes are? Scary thought. So let's talk about this. Here's the first change in the rule. You don't think this is coming? Already happened. They had this thing called Secure Act 2.0, and quietly this happened. Now, what this said is, this says if you have a qualified account, you have a 401k that when you leave work, you roll it to an IRA. And if you have this money and say, look, I don't want to touch this money, I want to leave it to my children, I say, well, unfortunately, the government's not going to let you just sit there with that money and save it. When you turn age 73, you are going to be required by the government to take a portion of that money out and pay tax. Next year, pull money out, pay tax, pull money out, pay tax, pull money out, pay tax till the rest of your life. Starts at 73. Now, this new Secure Act changed it. It used to be 70 and a half. And then they said, no, we're going to push it out to 73. There's even ways that it's going to go to 75. But today it's 73. You got to take a minimum amount out and pay tax. No problem there. Now, if you miss one of these distributions, 25% penalty. That's the highest tax penalty. Serious. They want their money. Here's the big change in inherited IRAs, and I'm going to explain to you what's happening. And if you don't think this is going to get more serious, here's what the government said. If I had a 401k at work and I rolled it to an IRA in retirement and I lived on this and I passed away, this IRA would now be my wife's IRA. I have to pull money out and pay tax while I'm alive. My wife has to pull money out and pay tax while she's alive. But when we die and inherited by my children, there's no cost basis step up. They got to pay tax too. But it used to be what they called a stretch IRA. In other words, the requirements on an IRA inherited were very small. They could take a little bit of money over their lifetime. Sometimes they wouldn't even use all the money. They'd pass it on to their kids. That's gone. You inherit an IRA today, not as a spouse. You got 10 years to cash that money out and pay all that tax. You want to know what I'm seeing? People are dying that I have clients with millions of dollars in these accounts. And these children at 55, 49, 50, they're in the highest tax brackets of their life, inheriting these millions of dollars, blowing all this up. I think about the mom and dad that worked their whole life for this money would be rolling around in their grave. Can you maybe do something to start mitigating this taxes? You can, but you have to take proactive, because you don't have to just sit there and take the government's plan. The government's plan, which is an RMD, at the end of the year, December 31st, the government says take a total of every qualified account you have. You have an IRA, he has an IRA, she has an IRA. We have a TSP, we have a pension. Whatever is a qualified plan, what is the total amount every December 31st? And then you got this number, they call it a life factor. We're going to divide it by a life factor, and they're going to calculate what the RMD is for the year. We do this for a lot of clients. It's complicated, but there's a formula. Now, to give you an idea, these are one of those life factor numbers at 73, that 26.5. The math on this is somewhere around 4%. If you had $1 million in an account, you would be required to take $40,000 a year out. And is that going to go up as you get older? It will. They're going to make you start taking money out of that account. But when we do the calculation on the RMD, if you had 500 grand, December 31st, at 73, you're talking about maybe 20 grand a year. Will that climb a little bit? I have clients that have $2 million, and they're sitting here at 83, and they're pulling 120, 150 grand. Now, let me explain something to you, what's going to happen to you and me, because I have a lot of qualified money as well. When we start taking money out of these accounts, these RMDs, I call them a tax torpedo. You start taking Social Security, you're in this nice little tax bracket, and all of a sudden you start getting these RMDs, and your wife's getting an RMD, and all of a sudden your tax bracket could go up. Your Medicare Part B could go up. Your taxes on Social Security could go up. And you're not planning, you're not making money anymore. You're pulling more of your money out and spending more of the money. And if somebody dies, all this qualified money is going to be taxable, and the tax brackets it's a mess. Do you need to plan for this? You need to plan for this. Whether you talk to your own advisor or really do some homework or talk to us, we're all going this way. And you have to decide, are you going to do this yourself or get help? So let me give you a couple of things. I think taxes are going to go up. Now, I'm going to tell you that with a lot of our clients, we have tax advantage investment strategies. That's one of the things that we do. We don't want our clients to just sit there and get hit by all this. If you could take an action and help. Does everybody get to take advantage of it? I can tell you they don't, but a lot of people do, and we kind of show you. There's this book out by one of my CFPs that works for me in my office, and we call it Tax Advantage Wealth Strategies, and we give clients this book, and we explain to them why we want some of these strategies in our plan. Now, what I'm going to tell you is one of the strategies we use is a Roth conversion strategy. This means you have an IRA, but you want to take some of the money out, pay the tax, and put the balance in a Roth. That's called a Roth conversion. When you're doing a Roth conversion, you are not doing a Roth contribution. The limits and how much money you do, all the rules have changed. If you had $1 million in an IRA, and I'm not suggesting you do this, but if you wanted to take all $1 million today and pay all the tax in one lump sum and put the balance in a Roth, why would you do such a thing? Because that $600,000, whatever it is, left over would then grow from here on out and would never be taxed again. No RMDs, and if you die, your children don't pay any tax. Now, I'm not suggesting you do that. You might want to do a little bit this year, a little bit this year, and you kind of piece it away, but you can take some of your IRA money and convert it with different rules, and we could help you on this and save you some money in the long run. The Roth IRA, and if you're contributing to a Roth IRA, good for you. You're paying into that after-tax dollars. When you retire, that is going to be a bucket of money that is not going to be taxed. You're going to pull money out of that, you're not going to pay any tax on it. The problem is you have limits to how much you can put in a Roth IRA while you're working. When you're converting from an IRA, there's no limits. And we look at this. Now, we look at tax brackets, of course. But I want to point something out to you. Let's look at that 24% bracket. Even if you're single, you might be at 100,000. Well, you can go up to 191 before we increase the bracket. That's $90,000 we could convert and not really change your bracket. If you're married, you've got $100,000 sometimes that you can convert, and really it's still saving on tax. Now, when that money goes over to the Roth, now that money's going to grow and get interest and whatever, and there's no tax to you and no tax to your heirs. So do we look at these strategies we do, and we can get aggressive or a little bit or however you want. How this looks in just kind of a shot here, let's just say we planned on converting $250,000 of $1 million IRA or 500, whatever, and we say we're going to do $50,000 a year for the next 5 years. So we're going to take $50,000 from the orange bucket, we're going to pay $10,000 in tax, and we're going to put $40,000 in the Roth. So we took $250,000, we converted it to $200,000 Roth. Now that $200,000 is growing and earning and never taxed and no RMDs. If the government changes the rules on qualified money, it does not affect that account. Something that you should consider. Sometimes we do that exact same strategy. We take money out of an account, we pay the tax, but we put the balance into a life insurance policy. Next year we pull some money out, pay tax, put the balance in life insurance policy. Why would we do that? And I'll give you an example. I had a couple that came and see me. They had 2 boys. And they had this IRA account. And what they were saying is, we're going to do this conversion. We're going to take this $500,000, we're going to convert it to $350,000 so we can leave our 2 boys $350,000. We do not need this money. We have other investments, we have pension, we have all this stuff. And I said, wait, got an idea for you. If it's going to be a death benefit or something you leave to your kids tax-free, why don't we take that conversion, 500, convert to 350, but let's take the 350 and put it into a life insurance policy. Why? Because when you pass away, your children are going to get $800,000 tax-free, not 350. Plus, you have some ability to pull money out of there. There's some things you can do with life insurance that we've never done before. Do I want somebody at retirement paying for life insurance? We don't. But if you could take an asset that you have and move some of that money over to one of these things, it has big implications for your family, sometimes even for you. You can get tax-free death benefit. You can take some of this money out tax-free from the cash. And if you go into a nursing home, you can use benefits out of these new accounts to pay your long-term care or home health care, no tax. So good things on there. Here's an example I had. You see $50,000 in one payment. I had a lady, sweet lady, 2 daughters. When we were talking to her about her plan, now she had a teacher's pension and some stuff, but we got to this account that she had $100,000 in. And we were talking about using that money and doing something with it. And I remember her saying to me, we want to go to Europe. My children want me to go to Europe, but I don't have the money. I said, you got $100,000 in this account. She looked at me with tears in her eyes, and she said to me, Tim, this is the only money I will be able to leave to my 2 daughters. I have not saved. This is all I have. And her daughters getting that money was very important to her. I said, I got an idea. Why don't you take $50,000, half of the money, let's put it in a life insurance and pay that up in one premium. Your daughters get $100,000 tax-free money. You take that other $50,000 and you go spend it and go to Europe, which her daughters were all over this to do. No other advisor told us that. I'm just saying to you, if you want to hear some of these things, there's things that we are doing that are helping people in retirement to fill situations. I'm going to leave you and close out with this. Who's helping you? You look at how complicated Social Security and Medicare options are. Do you want to navigate that yourself? Taxes, RMD, long-term care. Do you want to go through the investments in the market yourself? That's up to you. Or I'm going to say to you, if you're interested, you can come talk to me. But I want to kind of leave you with this one last favor. And I'm going to say this to you. I've enjoyed talking to you tonight, but this is a help for me. I'm asking for your help. If you fill this out, this is an evaluation form. And what you're going to do is you're going to rate me as a speaker. And if you think I'm pretty good, then you're going to give me some scores. And if you would fill this out and turn it in, I give it to the nonprofit organization, and that's how I get in front of more crowds like this. And of course, I get clients from here. Let me explain the rating system to you. I want to explain it. 1 to 5. 1 is not good. But if you give me a rating and you at least turn this in, I'm going to thank you because it does help me. Now, on the other hand, you're going to see that everything I talked about is over here. If you have an interest in that and you want to come in and meet with us, me, and talk with our team, we would love that. There's no charge. We'll have a discussion. We can explain more of this in detail. And what happens in that meeting, it's a friendly conversation. We hear kind of what you have. We learn a bit about you. We tell you how we work, how we get paid. We see what your concerns are, how we might help you. We decide if we want to go anywhere from there. That's if we decide we love you and that's great, but we got our own people, we go. But if you're interested in that, fill this out. I'm going to tell you, I'm not chasing anybody. We're not hawking you. I know I'm busy. But there's people in my office that will call you and say, if you want an appointment, they'll put you on my calendar and we'll talk to you. So please, I'm going to pass these around. Please fill this out before you go. I do thank you for coming. I'm up here for any questions. If I didn't answer, please do that. Thank you very much. Let me pass this out.